Imagine holding a handful of sand, just watching it slip through your fingers, no matter how tightly you squeeze. That's a pretty accurate picture of what's happening to your money, right now, every single day. For centuries, we've put our trust in this thing we call money, believing it's a stable store of value. But what if the system itself, the very foundation of our economy, is fundamentally broken? Today, we're diving deep into a book that completely reshaped my understanding of wealth, Lyn Alden's Broken Money. This isn't just another finance book. It's a revelation about why what you think you know about money is probably wrong. My goal here is simple: to pull back the curtain on the hidden truths of our monetary system and give you the knowledge to protect yourself and your financial future. This is the stuff they don't teach you in school, but it affects every single dollar you earn, save, and spend. To really get what's happening today, we need to take a quick trip back in time. Money wasn't always just paper or numbers on a screen. For thousands of years, money was a physical thing, a commodity. Think gold, silver, salt, or even seashells in some cultures. These things had value in and of themselves. Gold was valuable because it was rare, durable, and hard to find. You couldn't just print more of it. This gave it an inherent stability. If you had an ounce of gold, you knew it would likely be worth a similar amount of stuff next year, or even a decade from now. This is what we call commodity. Money. Then, things evolved. It became inconvenient to carry around heavy bags of gold coins. So, we developed representative money. You'd deposit your gold with a trusted party, like a bank, and they'd give you a paper certificate. A note that said, "This piece of paper represents 1 ounce of gold." You could then trade these notes, and anyone could go back to the bank and redeem them for the actual gold at any time. The paper itself wasn't the value. It was just a claim on the real value. This system worked pretty well for a long time, anchoring the value of paper money to something tangible and scarce. This was the era of the gold standard. But in the 20th century, particularly after major global conflicts and economic pressures, governments wanted more flexibility. They wanted to be able to create money to fund wars, social programs, and to stimulate the economy during downturns. Being tied to a fixed amount of gold was restrictive. So, one by one, countries cut the cord. In 1971, the US officially abandoned the gold standard, and the world entered the age of fiat currency. Fiat is a Latin word meaning "let it be done." Fiat money has value simply because the government declares it has value. It's not backed by gold, silver, or anything else. It's backed only by trust in the government that issues it. This gave central banks the power to create money out of thin air. And that single change set the stage for the world of broken money we live in today. Now, let's dive into the core arguments from Lyn Alden's book. This is where it gets really The first major concept is that inflation isn't a bug in the system, it's a feature. Fiat systems are deliberately designed for continuous, low-level inflation. You'll hear central bankers talk about a target of around 2% inflation per year. They frame this as healthy for the economy, encouraging spending and investment. But what does it really mean? It means your money is designed to lose 2% of its purchasing power every single year. Guaranteed. Over a decade. That's a significant chunk of your savings. Hustavani said. Over a lifetime, it's devastating. So how do they create this inflation? This leads to the second key point. Our system is debt-based. When you hear that the central bank is printing money, it's not usually running a physical printing press. Most new money is created digitally when loans are made. When a commercial bank gives you a mortgage, it doesn't take that money from someone else's savings account. It creates new money, a digital entry on its balance sheet. The money supply literally expands with every new loan. This means our entire economy is built on an ever-increasing mountain of debt. For the system to remain stable, more and more debt has to be created every year. If people and businesses stop taking out loans, the money supply shrinks, and the whole thing can grind to a halt. This is where central banks come in. They are the conductors of this orchestra. Through tools like quantitative easing, or QE, they can inject massive amounts of new money into the financial system by buying government bonds and other assets. They also manipulate interest rates. By lowering rates, they make it cheaper to borrow, encouraging more debt and expanding the money supply. When they raise rates, They try to slow things down, but for decades, the general trend has been towards lower rates and more debt. The long-term consequence of all this is a silent, relentless erosion of your purchasing power. Your salary might go up, but if prices for housing, food, and education are rising even faster, you're actually getting poorer. Alden argues this is a form of wealth transfer. It transfers wealth from savers and wage earners to those who own assets that rise with inflation, like stocks and real estate, and to debtors who get to pay back their loans with cheaper, less valuable money in the future. This isn't just a US phenomenon. It's global. Every country with a fiat currency is playing this same game, trying to manage its debt and inflation levels. It forces every single one of us into the position of being an investor. You can't just save your money in a bank account anymore. You'll lose to inflation. You are forced to take on risk in the stock market or other assets just to try and preserve the value of your hard-earned money. That is the essence of a broken system. So, the big question is, what on earth do we do about it? Understanding the problem is the first half of the battle. The second half is building a strategy to navigate this flawed system. This is where we need to shift our thinking from just earning money to preserving and growing real wealth. The first step is to understand the principles of sound money. Sound money, as Alden describes it, has key properties. It's scarce, durable, divisible, portable, and widely accepted. It holds its value over long periods. While we can't go back to a gold standard, we can look for assets that have these properties. This leads us to the idea of inflation hedges. We need to own things that do well in an inflationary environment. This includes real assets, things you can touch. Think productive businesses, either owning your own or investing in great companies through the stock market. Think commodities like gold, silver, and even energy. And of course, hard assets like real estate. These things are scarce and tend to rise in price as the value of the currency falls. And in the 21st century, a new contender for a sound money asset has emerged. Bitcoin. Because of its programmed scarcity, there will only ever be 21 million its shares. Many properties with gold, but in a digital form. Alden spends a lot of time analyzing its potential role as a long-term store of value in this broken system. We also need to rethink debt. In an inflationary world, not all debt is bad. Taking on a low-interest fixed-rate mortgage to buy a house can be a powerful financial move. You're borrowing money today and paying it back over 30 years with future, less valuable dollars. All while the value of the house itself is likely rising with inflation. That's smart debt. In contrast, high-interest credit card debt used to buy things that lose value is a wealth-destroying trap. The final piece of the strategy is embracing long-term thinking. Don't get caught up in the day-to-day noise of the markets. Focus on acquiring quality assets that will preserve and grow your wealth over decades, not days. It's about building a financial fortress that can withstand the storms of the fiat system. To wrap it all up, the key takeaway from Lyn Alden's Broken Money is that our monetary system isn't a neutral, stable backdrop to our lives. It's an active force, one that is designed to systematically devalue currency and transfer wealth. But this knowledge isn't meant to be discouraging. It's empowering. Once you understand the rules of the game, you can start to play it differently. You can stop letting your wealth bleed away and start making conscious choices to protect it. You can move from being a passive victim of inflation to an active architect of your own financial freedom. It all starts with opening your eyes to how money really works. What's your biggest takeaway from understanding the concept of broken money? Has this changed how you think about saving or investing? I'd love to hear your thoughts, so share them in the comments below. And if you found this breakdown valuable, don't forget to like this video, subscribe to the channel, and hit that notification bell for more insights to help you on your wealth journey. Thanks for watching.